Hello, everyone, and welcome to this podcast. If you have been learning a few things from this podcast, make sure you hit the like button as well as follow, which keeps us motivated to bring to you the latest from the Indian stock market, from the cryptocurrency world. But today, we have got an international view of the stock markets, and we are joined in by Mr. Clemen Chiang, and he'll be addressing something which we haven't been doing in the last 1 year. He is an expert in trading psychology and has been doing the research in the last 25 years. So let's welcome Dr. Chiang. Welcome, Mr. Chiang.
Hello, Aniket. Thank you for having me. Hello, everyone.
Yeah. So let's take the bull by its horns and talking about trading psychologies. Which one thing do you think is the most important thing right now? Because we have been seeing these stock markets in the bullish runs in the last 15 months, and there is some kind of a complacency which is coming in the traders' mind, especially the beginners. And I would like you to address one or a couple of points which are right there up in the list, which would like to tell my viewers so that they are ready for it and don't make mistakes in the coming 4 to 5 months, or maybe the coming year, which is expected to be some sort of a bubble. Is it a bubble, first of all, and then you can have your trading psychology?
Yes, Aniket, that's a great question. This goes back all the way to the year 2000 when I first started investing in the stock market. And in fact, I started off my first 5 years just do pure options trading at the Chicago Board Option Exchange. So what I've witnessed over the last 20 years is a complete cycle. For example, the very next year after I started investing, that was 9/11/2001. The terrorists came and kind of bombed US and the market crashed. And 2 years following that, that was in 2003 when the US led the invasion into Iraq for reasons, what they call weapons of mass destruction, but they can't find any nukes at all. So, history really tells us a lot of interesting stories. And fast forward that to 2008 mortgage crisis, we call it the financial crisis, the market crash. And, that was a really, really steep learning curve. And thereafter, last year, we experienced the pandemic crash. Wow. Exactly. What a great roller coaster ride it has been to severely test our fear and greed. So in regards to your question, what I found over the last 20 years is a golden rule. And this is something not taught in the textbooks or not found anywhere. And that is, we came up with this kind of a golden commandment. Number one, thou shalt not buy more than 5% of your portfolio into any single trade. 5% of your capital, this is a golden commandment. So if you take 100% divided by 5%, at any one point in time, you can deploy maximum of 20 different trades.
Exactly.
This is golden rule number one. But there's a subset to this rule, and that is we should not sell at a loss. Now, this is going to be hard to digest for most traders out there who are trained to put stop losses and they kind of trying to stop out the moment the price dips. That's not our belief, because what we found out is that take, for example, the great company today that is Amazon. In the year 2000, everybody suffered from the dot-com crash, right? Yeah. And then we detailed back at the peak of 2000, the stock price of Amazon, how long it took for them to hit break-even price. And guess what? Aniket, it's just 10 years. Exactly. If you don't realize a loss, 10 years later, you break even, and today is soaring at an all-time high. You're sitting on really, really nice profit.
Exactly. So this point of time, I mean, for a beginner, should he perceive this bull run as a learning curve rather than a time when he can create the wealth of his entire life? I mean, you talked about investing just 5% of your portfolio in one stock and giving, like, if you've got 100% with you, you have 20 attempts at the market, 20 goes at the market, right? And those 20 attempts can be seen as 20 learning curves from which every trader can learn. And as a wise man once said in the stock market, that if you are there to learn, then only you can earn. But if you're there only to earn, then you will only learn. So do you think this particular bull cycle of 2021 can be perceived by beginners as a learning curve rather than an occasion wherein you can just enjoy and try to make the wealth of your entire life, maybe?
So if you want to tackle the idea of learning journey, and this is my 2 cents worth, because if in the dot-com era, it took 10 years to break even for Amazon stock price.
Exactly.
Then if we fast forward to somewhere nearer to us, 2008 financial crisis, that period of break even has shortened by half to 5 years. 5 years, that's what it takes to break even on the Dow Jones Index. And then if we fast forward to just last year when we had a pandemic crash, you know how long it takes to break even? It took us just 10 months.
Exactly.
So from 10 years, we reduced to 5 years. And then from 5 years, we reduced to 10 months. That learning curve, in that sense, Wall Street has become smarter. The US government has become smarter. 2008, it started off with quantitative easing, flushed the market with cash, and Obama had a solid 8 years tenure starting from 2009. And we're just riding on Obama's leadership. We make easy money. You see the Dow Jones is on a 45-degree stock flight. Right now, we have Joe Biden, the number 2 man under Obama administration, following exactly the same playbook. But guess what? He's pushing and flooding the market with 10 times more money. Obama flooded with 800 billion. Joe Biden flooding right now with 8 trillion, combined with Donald Trump signing out 2 trillion worth of stimulus. So there's 8 trillion right now in the market. It's not a time really to learn anymore. It's time to make money.
Exactly.
You have a very small window. And what I can say is that learning curve, as long as you follow some golden commandments like don't invest more than 5%. And because of the way that we handle data, we have the best data right now on insider trading in the US market, from the billionaires, millionaires, all the way to sovereign wealth funds. And we add a layer of AI on top of it, we get to see where the hot money is really focusing on. Now, this is really, really important. That's the reason why there's no need for us to place a stop loss, because these companies are backed by very, very strong positive inflows of funds, and you just need to give it a sufficient time for it to play out its strategy. So answering your question, Aniket, this is really truly the journey where, roll up your sleeves, get yourself into the market and start trading.
Right. So how do you perceive the recent Fed decision to prepone the rate hikes and the repercussions which it had on the international markets? Like, we in India also faced a couple of bearish days in the markets, and I mean, the committee, the 18-member committee of the Fed headed by Jerome Powell, there was no unanimity there as well. So a few of the members wanted the rate hike in 2022 itself. So how is it going there in the US markets, and how do you perceive those decisions?
So first of all, let's address 3 very, very important points. First is the decision by the Fed chair, Jerome Powell. And he has been floating around a very, very dangerous word, and that is called transitory.
Exactly.
And kind of send the whole market into a spiral. What do you mean by transitory when we are hitting 2 consecutive months of the CPI increase and the latest CPI percentage hits 5%? Now, this is a very dangerous level. Over the last 20 years, the moment it touched 5% is a major red flag. And if it goes above 5%, it means to the ordinary man, for the same $100 that you have today, you're going to buy lesser amount of goods and services.
Yeah, I mean, even if we don't go with the CPI index and all of that, even if you step out of the home and you go and shop or you utilize services, you are getting that, you're feeling that heat of inflation going around. So it is really bouncing up, and here in India as well, the core inflation has shot up to 6.5%, and that is the highest after 2014. So yes, inflation is the biggest concern right now.
Now, that is a combination of 2 factors, Aniket. First is you feel that things are getting higher when you go out there to shop. Now, that's because of a severe pent-up demand. We've been locked down officially more than 1 year already. And for all the savings that you accumulated from traveling overseas, from shopping at the duty-free shops to going to airport and cruises, there's a lot of money in everyone's pocket, as it seems. That's why there's a pent-up demand to buy goods and services. And of course, the retailers will take advantage of that to raise prices. Everybody wants to make more money. So coming back to Jerome Powell's decision, there are two keywords that we need to understand. First, the idea of hawkish behavior is really coming on stream, and that's the reason why they're going to raise interest rates, pull it much earlier in the year 2023. Right. So the Dow Jones took a hit on that, no problem, right? And then the second keyword is tapering. Tapering means they're going to cut back on buying out the assets in the market. Back in the days of QE, back in the days of current days of stimulus. That means to say, these two keywords, tapering and hawkish behavior, kind of send a dampening effect on the Dow Jones. And you can see the market took a hit, but yesterday Dow Jones rebounded. Yeah. So we have absorbed all the bad news, and right now is the time for the market to rebound. And we are seeing a really nice window of opportunity for the next 12 months. Now we are counting down. If we go trace back to 2009, when Obama brought in QE in the very first 100 days of his office, straight off in the first year is the golden year. The golden year where the market just fly off 45 degrees off the charts. Right now, we are officially in that first golden year of Joe Biden. Right. And that's the reason why, all this short-term adjustment, short-term volatility, I would suggest to the audience that, do not be taken off. In fact, all the more you must plow into the market, and there's so many great opportunities every day.
So yes, if this is the biggest bull cycle of this century, and you mean to say there is a lot more steam left to it even now, and 8 months or 1 year earlier, we have been discussing on my YouTube channel and podcast as well that the end of 2021, you should be a bit cautious by the starting of 2022. But you just mentioned 1 more year to go, and we can still be a part of this melt up phase. So what stance do you have? Like exactly, should we assume that 1 year again is there to go for this melt up phase to exhaust?
I think it's going to be more than 4 years. Honestly, we look at the playbook of Obama. Back then, it's only 800 billion. And 2009 to all the way, you add 8 years, 2016, the full 8 years, the market was on a 45-degree flight chart. Right. That's only 800 billion. Right now, we are getting 10 times of that, 8 trillion. Add one more zero at the end. And for 8 trillion, you see what is happening at this moment, the only Achilles heel is the COVID-19. COVID-19 is the dampener that has raised a severe question mark in the thinking of the Fed chairman. And he brought this up as well. There's something that we have to just continue to vaccinate the population, clamp down on the virus, opening up the economy, make sure the flights start to take off and the cruises start to sail. That's what he can do to inject life back in the economy. But that being said, because coming to the next election, that will be 2024, our assumption that for all the good things that he had done, probably he will win a second term, just like Obama winning a second term. But by then, he has a much, much bigger threat than the domestic economy itself. He's facing a real giant out of China. So that is the real threat that we look at into the marketplace. And, China is coming on stream really, really strong. And by next year, 2022, they will kind of officially launch the digital Chinese yuan. That is a digital currency. And this has a severe threat to the US dollar. So, all said and done, that's the reason why Joe Biden is asking for the largest budget ever in the history of Wall Street, ever in the history of US government, to fend off this rising threat from China.
Right. So the rise of cryptocurrencies as well, I mean, it is still at a very minuscule level, but that also is posing a threat to the US dollars to some extent, not to a greater extent right now, but I mean, how do you perceive that as well? Because that will create a pressure on the US dollars again.
And that's a great question, because what we want to take heed on is what are the real giants doing on Wall Street? So clearly, we have the first giant, Paul Tudor Jones, a renowned investor, founder of Robinhood Foundation.
Mm-hmm.
And last year, during the interview, we were trading on the same time. We were trading on the first day of the Bitcoin halving, 12th of May 2020.
Yeah.
And back then, he allocated about 2% of his portfolio into Bitcoin. And this year, he came back to the same interview at CNBC. Guess what? He has increased his allocation of his asset under management to 5% to Bitcoin. and he shared openly that, if the Fed is not going to do anything right now, still on a kind of laissez-faire, having a transitory mood, then he will go all out on what we call the inflationary trades. And that is having much more aggressive stand allocation into Bitcoin, into commodities, into cash, into gold. And the other only 80% is a question mark on what are the trades to play for inflation.
Yes, yes, exactly. So, to cut it short and have a very cut and dried formula for the coming 1 year, there are people who are still waiting for a deep correction and not willing to buy higher highs. They are waiting for the lows, I mean, the corrections to enter. What cut and dried formula should we present them? Like, is it a good ploy to buy the higher highs even now? Until what point do you think that you can keep on buying higher highs?
So to this group of, maybe I don't even call them investors, to this group of people who are thinking about investing or trading, first thing they should do is they should walk straight into their neighborhood banks where they kept their money and ask the bank officer, Mr. Bank Officer, may I know what is the interest rate you're paying for the amount of money I kept with your bank? Exactly. And I can tell you the answer from the number one bank in the world, that's DBS Bank of Singapore. They are paying only 0.36% per year.
Yes. And then they should
Not even
also
accounting
get
for inflation.
exactly. And they should also get hold of the calculator and calculate their entire life's savings which they made and how much the bank has earned out of their own savings. So this will maybe pop some idea into their minds. So
No, if the bank wants to make money from the savings that we put with them, no credit goes to them. But the real thing is that the money that you kept in the bank is declining and depreciating because you're going to buy lesser goods and services. That's the reason why it's not about higher high or lower lows. It's about you have to make sure your money is working hard for you. That is the crux question. Yeah.
Yeah, so that is one of the major traits of a good trader, that he is ready to buy higher highs and he's also ready to sell at lower lows. Well, so which one particular aspect of trading psychology like stands out for you?
So trading psychology, there are two parts. So we are dealing with fear and we are dealing with greed. So let's tackle out the fearful part. The fearful part, in order for her to have a long runway to be sustainable, like investing for 20 years, is that you must have a golden commandment. And we stick to this. We do not break this rule. We don't allocate more than 5% of our capital into any single trade. That is golden rule. And right now, because we are backed by AI data, then we say that we do not put a stop loss. We are willing to wait out. So we have positions like 3 years took me to break even, 4 years to break even. We are very, very patient in that sense and being forced into what we call long-term investing. Mm-hmm. So once you have this mindset, you take away the fear component. Now, the next step is to handle the greed component. The greed aspect of our human nature is this. Now, if I know that a bank is paying me 0.36% per year, then jolly well, if I can do between 5 to 100% return in one day, I've beaten all the banks in the world. So we like to get into the position whereby if I can kind of straight away look into my account and have a portfolio, have positions that are in green, 5% or more, I'll take the profits. And then I wait for the next trigger event. So this has been the way that we have been investing, and we found this way to be the fastest way for you to accumulate your portfolio, especially when your starting capital is small. Now, most people got the whole idea twisted or indoctrinated with the wrong thinking. And that is this. If your capital is small today, truly, you can't afford to do it long term. And that's very dangerous because long-term investing is for those who already reached the top of the pyramid. I'm talking about millionaires who already been there, done that, have $1 million cash sitting in their account. They can afford to wait, but not for the ordinary man. The ordinary man, you have bills to pay. And there'll be times of emergencies like a COVID-19, your loved one fell sick, go to the hospital, you got medical bills to pay. You got expenses to pay out every month. And those are the kind of pressures that the ordinary man is facing each and every single day. They can't afford to do long term. They got to have the motivation and momentum to drive such that they are getting short-term profit, and just keep plowing through. And the journey is exactly what you said, Aniket. The whole journey is learning to acquire wisdom. That's the whole journey of investing.
Yeah. So the power of compounding to some extent can fade away into insignificance if you take into account the power of momentum. And in this particular bull run, the power of the US Fed flooding in liquidity into the system. So people even if you don't want to do it the Warren Buffett way, you can attempt the Elon Musk way of doing things and making use of the power of momentum, especially when we have times like these wherein the liquidity flow is superpowering every other market factor right now. And I think each and every investor or trader should take part in this and experience this great bull run that is going around, which is also called as one of the biggest bull runs of the century.
Yes, absolutely right. But there's two components that must be inherently strong. Mm-hmm. The first component is we must have very, very superior data. So, this is where my fintech work on it day and night. Our engineers are working really hard on it. We are getting the best data right now of every insider trading activity. And I'm talking about 100% legal insider trading activity that's happening in the US market. At any point in time, we know what BlackRock, State Street, Vanguard, what the sovereign wealth funds like Temasek, Saudi Arabia, Abu Dhabi, and what the billionaires like Warren Buffett, George Soros, Nick Schumer, James Simmons, whatever they are buying and selling. Data is superior. You need to have very, very good data. Number two, you need to have very, very good education. So some people have the data, but they have no education on what is a methodology, what is a strategy to execute on. They still collapse in the market. So we found that a combination of the two, that's the reason why our company built into fintech and edutech, making sure you're equipped with data and really the latest know-how, how to execute on the data to make profitable trades in the market.
So this was really enlightening listening from you, Dr. Chiang, and I hope our listeners are enjoying it too. Guys, if you're enjoying it and if we want Mr. Chiang to frequently visit our YouTube channel as well as our podcast, make sure that you hit the like button, as well as if you've got some questions. In the description, I'll be mentioning the links in which you can contact Dr. Chiang and a few of his social media handles as well. So get in touch with him, do comment, and also subscribe and follow this podcast and the YouTube channel. Thank you, Mr. Chiang, and it was really a pleasure speaking to you and knowing so much about the stock markets, the way you perceive them. It is really I mean it was really encouraging to see that you are still banking on the power of momentum in the stock markets. And the Joe Biden story that you told and the way you compared it with the 2008 scenario when Obama was the president, it really tells us that we are really evolving, the markets are really evolving, and the reflections of the same are seen here in Asia and India as well.
Yeah, thank you so much, Aniket, for having me, and I hope your listeners will have a refreshed perspective of how to look at the market. Thank you very much.
Thank you. And we'll be joining soon once again for sure.